able to present. We are thrilled to be able to present to you today our friends at from Lincoln Financial, specifically Kevin Cox, supported by John Kimmel, who are going to talk about the cost of guarantees and their variable product and products and some other products that have recently been released by Lincoln. For those of you that we recently hosted at our Agency One annual meeting, the end of April in Washington, D.C., Kevin was supposed to be part of a panel discussion, and unfortunately, circumstances existed such that he was not able to make the meeting. We were so disappointed that Lincoln was not represented and that we could not share this information with you, that we thought it was important enough to offer Kevin an opportunity through a webinar to present this information. So I am in a minute, I'm going to turn this over to Kevin. He's got a whole presentation that he has prepared. If you have any questions, please submit them through the chat feature or through the Q&A, and I will address them with Kevin at the end of the presentation. Agency One has a long-standing friendship with Kevin and a long-standing relationship and friendship with our friends from Lincoln Financial Group. Kevin is an advanced sales consultant for Lincoln Financial Distributors and he is based out of Vienna, Virginia. His responsibilities include supporting distribution of life insurance and annuities to the affluent and emerging affluent through financial planners. He has worked extensively for 40 years with professional advisors and their clients at the intersection of products and concepts. We have been privileged to have Kevin speak on our behalf before. He is always well received. I don't mean to put any additional pressure on you, Kevin, but thank you for agreeing to take this time to speak with our advisors. And with that, I am going to turn it over to you.
Well, thanks, Kathy. I appreciate the opportunity, especially to come on after I couldn't make it, and that's because I caught the Wu flu or whatever they want to call it. And maybe I should be wearing a mask today, I'm not sure, but all's good now. Unfortunately, it's the way it works out, and sorry about that. I wish I could have been with you. Agency One's great people, known, well, we go back a long ways. I kind of wish it wasn't that long, but does go back probably 40 years. Anyway, let's talk about the topic that we were going to talk about on the panel, and I think the other panelists maybe talked about, is the fact that Bobby Samuelson opened up your meeting and talked about accumulation products and the new 7702 regs and how great it is. And the products are much more efficient on an SRP, supplemental retirement planning design, LERPs, if that's what you want to call it, private, and whatever you want to call it. And I think that's probably was discussed extensively. So today, what I want to do is I want to take kind of the accumulation product and take it in a mortality direction, because it is highly flexible and does offer some really great opportunities to use it as a death benefit product. And I'm going to use that, I'm going to compare that to VUL1, who you're probably familiar with, no lapse guarantee VUL1, and you could do it on UL type side too, but I'm going to use this product. So I want to go through that because I think it could open your eyes to some opportunities to communicate with your clients and the other professional advisors in your world, so that you enhances your relationships, not only with them, but to get more referrals. Because I like the idea that insurance isn't a product, it's really a portfolio, just like investments. And we all want to talk about investments versus insurance. So let's start with our presentation. Let's see if I can share my screen, see if this works. I sure hope so. Let's do this, see if I can get rid of this part of this up here. I can't for some reason. Get this to come down. All right, I can't seem to get this in the right format, but it's good enough for today's work, I think. Let's see if I can do it this way. Yeah, that's a little bit better. Okay. I kind of titled this The Cost of Guarantees, or maybe we could call it guarantees versus non-guarantees. And I want to look at this from the perspective of product versus product, but as also as maybe product plus product. Okay, so let's see if we can make this thing move forward. And let's see if, in your system, I've got to make sure how these systems work. There we go. All right. So I think we could all agree that when we're doing insurance, we all prefer guarantees over non-guarantees if the quote cost isn't too prohibitive. Okay, and that's what we want to look at today. And what about flexibility? And if it's unclear what product is best, perhaps more than one product is best. So let's look at our client. This is Max. He's a 50 preferred client. This is a death benefit case. We're going to look at $1 million of coverage. He likes the guarantees. Who doesn't? But he's a cost-conscious guy, and he likes flexibility. Like, what about the future? What if things change? So let's start with our typical solution here, which is going to be VWell 1, which you're certainly familiar with as one of the major products in the industry, guaranteed no lapse VUL. Okay, has a lot of advantages to it. Okay, so for some reason I can't get this top thing to move and get me to a. I'm just going to try something here for a moment, if you don't mind. Well, can't get it to move. That's all right. We'll have to deal with it the way it is.
Hey, Kevin, if you click the up at the top in the orange menu at the top, you see that thing that looks like a screen.
Yeah, but the problem is
the
problem is the other part of the system is covering it up and it won't go away. I can't get it to move, and I'm trying to, so I can't get it to go away. And it's
okay, well, we can work with this, I think.
Yeah, we'll work with it. You guys can see it. I mean, it's no big deal. You got my notes in there, but this is for your benefit in terms of understanding. But here's the case. So what do we have here? I hope you see my cursor. VUL 1, the premium's shy of $14,000. I just ran a lifetime pay guarantee, nothing fancy. And case design is what it is. You get a real case, we do lots of analysis. $14,000 premium, guaranteed for life. The life expectancy on this case, about age 85. It's like halfway between 85, 86. I use 85 because, when you talk to people about when they die, nobody dies at 86, right? They're going to die at like 80, 85, 90. Nobody dies at like 92. They just don't, right? They don't think that way anyway. So what's the cash at 65, in year 20, age 65, age 70, it's 284, which is basically a break even. So the cash value at 6.5% breaks even. And now I want to make a big note here on this product. And this is from a communication perspective. Notice that in my note here, the death benefit at age 85, if we put all the premium cash value in the American Funds Growth and Income Fund, and we can do this in our illustration system, what it shows, and again, it's historical, it's not going to occur again, but just from historical perspective, the death benefit at age 85 would be 2.8 million, not $1 million. That's because the rate of return was so good. That's actually an 8.33 IRR. Interesting. Okay. Now, I don't know if anybody on the call follows Bob Keebler out of Milwaukee, CPA. He's involved with Steve Leinberg, Lisi, and does a lot of webinars. He does some really great work. But he coined the phrase, bet to live, bet to die. And I really like that phrase from a communication perspective. Well, bet to live. What is bet to live? An example is an investment, right? If you make investments, to be successful, you need two things. You need time and growth. Okay, we understand that. But insurance is the opposite. Insurance is a bet to die strategy, right? I mean, by buying insurance, you kind of betting you're going to die prematurely, and the insurance company is going to bet that you're going to live to life expectancy or beyond. That's the bet. And what's interesting about a VUL1 no lapse product is the death benefit isn't $1 million. I mean, it could be, say, 2.8 million, which really represents that the product is not only bet to die, but it's also bet to live. If you live a long time and you get return and you have no reason in a no lapse contract not to invest aggressively, you could end up with a great bet to live result. So anyway, I wanted to bring that language to you because I thought Bob has some great language that you can use with your clients and with other professional advisors. So that's a little off topic, but not totally. All right. So the question here is, well, okay, that's really good, but can I improve that IRR at death? What could I do? Well, let's look at our new Asset Edge product, but not from an accumulation perspective, like a max funded supplemental retirement plan or LERP, but just from a mortality perspective. So all I ran was a 6.5% Endow at 100 premium, which came in at $99.14, $10,000. Now, this product only has a guarantee of 70. Well, I'm not sure I like that, but gee, it has a 528 IRR. Wow, at a life expectancy, that's a lot of improvement. I have to give up some cash. Well, I didn't put any premium in. I understand that. Over here is your target. Now, so what does that tell us? Well, gee, I like that 528, but I'm not sure I like that 70 guarantee. Well, there's not a lot we can do about it in this product, but how do we enhance the product from various perspectives? Well, one of the questions is, well, what if I put the same premium of VUL1 in Asset Edge? Okay, what does that look like? Well, it doesn't change my guarantee. It lowers my IRR. Now you're probably wondering, well, how can the same premium at 14,000 die at 85? How could Asset Edge have a greater IRR than VUL1? Well, that's because the death benefit on VUL1's $1 million, and the death benefit on Asset Edge is more because you hit corridor because of outperformance. Okay, so that's just corridor hitting. So from that perspective, I get a bump on my IRR. My cash value is up a little bit. It does improve the cash. Okay, well, how could I further improve this? What if I looked at option 2, using the same premium on Asset Edge? Well, I can't change my guarantee, but note my IRR at life expectancy. Now I'm over 6. So what I did in this case is I just made the death benefit $1 million in year 1. Now in our product, I had to make the death benefit $870 because we have a guaranteed 115% year 1 on option 2 automatically. That's to get more money in for premium for quote SRP max funded. But in this case, it's kind of interesting because in a death benefit play, actually I can lower the death benefit. Now what's interesting here is note that I lowered the death benefit, which usually affects target premium, but the target premium went up. Interesting. So you're rewarded for working a little harder in this design work. By the way, you have cases, glad to help out. I do this all the time. Glad to help you out on these cases. Help out Agency 1. They're great friends. Glad to support you in this design. Now you're looking at this, and I'm saying it as an advisor, saying, wow, this is really interesting. I really like that 614, but I do like guarantees, and my client really likes guarantees. And what do we do? He is only 50. So there's a lot of flexibility that may have to be addressed in the future. Well, what could we do? Which product is best? How about we buy half of each? What would that look like, and how do I illustrate it? Well, that's usually hard to do. So what we came up with is a multi-product illustration system where I put both of these products together. In fact, in this system, I can put VUL1, Asset Edge, I could put term with it, I could have 3 policies, I could have 4 policies, I could have survivorship with individual products. I can do anything I want in one ledger with one graph. So in this presentation, this is only one page out of the presentation. I'm not going to bore you with a whole bunch of pages. It drives me nuts. Here you are. This is a cumulative premium. The red line's cumulative premium. Obviously, if this was a short pay, this would just drop off. Or if it was an SRP, it would actually go down and go negative. Here's your cash value line. And here's your death benefit line. Half of the premium of the 13,956 goes to VUL1 for 500,000. Half goes to Asset Edge. What did we get? Well, you can see here at year 20, I'm break even. If you look here, it's a little hard to see, 48 basis points, that's break even on the cash value. Okay, but at year 35, down here, notice year 35, my death benefit's up to 1.2 and my IRR is 4.79, call it 4.8. So 4.8 versus VUL1 guaranteed at 3.68, call it 3.7. So I picked up 110 basis points. I picked up flexibility. And because now I have two products, maybe at certain points I don't need both products. Maybe I can turn one into income or surrender it, do whatever, but keep the other one. Not as easy to do if I was all in a no lapse contract. Kind of doesn't work as well from a management perspective. Now, but we need to go back a minute. If you notice that death benefit at 1,263,000 at 4.79. Well, what is of interest to me is that, remember in the original slide on VUL1, I noted that on a historical basis, the $1 million policy would have been worth 2.8 million at age 85. Well, all we have to do in our head is what? It's fairly obvious. If I had a $500,000 policy, the death benefit on a historical basis would be 1.4 million. So 1.4 is $900,000 more than $500,000. So therefore, if I add 900,000 to 1.2 million, I get 2.1 million, potentially. Well, if this were 2.1 million down here, what would the IRR be? And the answer is 7.21% tax-free. Is that good? Well, it's quite good. So here, what did we end up with? Well, which is the best product? Perhaps that's not the question. Perhaps the question is, what's the best plan? What's the best portfolio of products? This is just an examination of two products, just because for our presentation, we're comparing non-guaranteed versus guaranteed in a VUL environment. But you could match IUL with VUL. You can match survivorship with individual. We will have soon this presentation that you're seeing here in survivorship format, because we just launched on Monday our new SIUL product. Now that would work well with what? In combination with our SVUL1 product, where you would have guarantees for life. And our new product, SIUL, has a guarantee on a level DB basis. We'll have a guarantee to 95. Okay. But we also are adding to our SIUL option 2 and option 3, return of premium. For those of you out there who do split dollar, the product is going to work really well in private split dollar scenarios. I've already done some analytics on that. But we also have an inflation rider at 3%, which is very exciting for private split dollar, private finance cases. Also, the SIUL product has really good cash value, kind of surprising to us. And it's starting to look like that product will premium finance quite well. So we'll be back to you with a lot more information as we're evolving and learning about that product. But if you think about it in the context of the graph you're seeing, this presentation, well, I'm doing a lot more of these cases from an estate planning basis, where I'm combining survivorship with single life coverage. Now, why am I doing that? Well, let's take our 50-year-old here. This is just an examination of a 50-year-old. Now, most of our survivor cases are older, but we're getting a lot of very wealthy younger people today. let's go back to Max. He's 50. We tend to focus on that age 85 number, right? Age 85, life expectancy. We all talk about life expectancy. And I kind of was facetious in the beginning, talking about the idea that all of our clients certainly die only at age 85 or right on life expectancy, right? Well, of course they don't. Actually, for Max, age 50, even as a preferred, 25% of that age group, preferred, will be deceased by age 80. So in a survivorship case for estate planning, if we have younger lives, should we consider the concept that maybe we buy the survivorship, but we also buy some individual coverage either on one life or perhaps on both? Why? Because in the case of a premature death, the trust then has an influx of tax-free capital, which provides incredible flexibility to paying future premiums on the survivor contract. Maybe you do a short pay single life combined with a long pay survivorship. There's one idea, and we just pay off the survivorship gradually with all the money that comes in from the premature death. Maybe you premium finance single life and not survivorship. I don't know. There's a lot of combinations. It's all dependent on your case, which is really what we do and what Agency One does for you. So I just wanted to bring this to the table for discussion purposes today, to not only let you know the product exists and the new Survivor IUL exists, but the combination of products I think can help set you apart from the competition, because now you're an advisor and you're managing the insurance over time to its lowest possible cost, which is a totally another presentation we could provide later on. I'm very excited about that. So anyway, I took about 20 minutes. I didn't want to take any more today. And so with that, we'll say thank you, and I'll turn it back over. I'll turn it over to John for some closing thoughts.
Well, Kevin, thank you very much for your sales ideas here. I did see there was one question in the chat that they asked, how on your level death benefit of the VUL1 did you get up to? Was it 2.8 million of cash? And I believe the answer to that is you backed in the historical rate of return of 8.31%, and the cash value forced the corridor up to get it to the 2.81 million.
Well, and the 2.8 million was on VUL1, and because on VUL1, if you think about a VUL1 or SV1 type contract, what do we have? We have a guaranteed premium and a guaranteed death benefit. So the cash value performance is not irrelevant, but it doesn't, you're not going to lose the guarantee, right? The premium isn't going to change. The death benefit cannot go below a minimum. Let's think about it as a trustee managing the policy and the cash value. What asset allocation would I do? Am I worried about the cash value, like an asset edge, where I have to have a positive cash value to keep the death benefit alive and the policy alive? No, I'm not worried about that. So as a trustee, or as I'm the investment manager, I'm looking at the cash value of a VUL1 type contract and saying, well, I have nothing to lose. I mean, if I'm really betting on mortality for the product, as opposed to maybe accessing the money for some other reason, which is always possible. But if I'm really into it for the death benefit, that means that I could aggressively invest. Now, let me ask everybody, people on the call who are investment oriented, is the American Funds Growth and Income Fund super aggressive? I don't know. I use it for this reason. One, everybody knows American Funds. Two, that fund in separate account format that we use has a 36-year track record. So if you think about it from a life expectancy basis, it goes beyond most of our cases. Not all of them. We're working on some younger cases. I know that. But if you think about it, if you're working on a survivor case or an estate planning case for a 65 or 70-year-old, well, 36 years is beyond life expectancy. So it kind of gives you a viewpoint of the potential of the product for the future. That's all it does. It doesn't say it's going to be, it just says, if this had occurred. which of course we know will not occur again. But it's that 2.8 million is the death benefit under VUL 1 if in 1984, I think when it started, for the next 30, 35 years for this client, what would have happened to the product if the American Funds Growth and Income Fund performed exactly like it did. Okay, sorry. And that the death benefit, by the way, on the question, Steve, is the death benefit did not get to 2.8, got to 2.8 million on the VUL 1 on a level death benefit because the cash value grew so much, it pushed the corridor up. That's what it did. It just kept pushing the corridor up. I didn't put the cash value in there, but the cash value of the 2.8 million DB is probably about 2.6 million or something like that. Anyway, it's a corridor case.
Thank you, Kevin. And again, just to reiterate that we did roll out the survivorship IUL this past Monday, May 16th. And for those of you who have any pending VUL 1 cases, we are scheduled to do a reprice of the VUL 1 beginning of June. Pricing improvements will be between 10 pays and full pays. So if you have a case in underwriting, you would automatically get the better pricing. But just be aware there will be improved pricing coming out in June. And I'd certainly like to thank Agency 1, Kathy, for again giving us up at bat again. Unfortunately, Kevin and I were both sick for the meeting, and I don't think you wanted us sitting by your agents.
No, absolutely not. But thank you, guys. If anybody has any further questions about the presentation that Kevin just gave and you know, Lincoln and how their products work, please type them into the chat while we've got Kevin and John on this webinar, and they will be happy to address what was covered in this presentation or any other questions, frankly, that you might have for Lincoln at this time. The other thing that I would like to do is remind everyone that most of the presentations that were provided or that were given during our Agency 1 meeting are on the Agency 1 portal. So if you are an Agency 1 100 advisor, you can get access to them. This presentation that Kevin just gave will also be on the portal. And as we had mentioned, this is being recorded. I am not seeing any additional questions coming in. So with that, I am going to thank you, Kevin, and thank you, John, for your time. I hope that the attendees have found this valuable. And if you've got a question, if you've got would like some illustrations run, please reach out to Agency 1. We will be happy to help you. If you'd like to go offline with Kevin and or John, we'll be happy to set up a call as well if you've got something specific that you'd like to discuss and take it outside of this webinar. So with that, we are going to conclude this half-hour presentation. I wish everybody a wonderful Memorial Day weekend, and have a great summer, and let us know how we can help. Take care. Thank you, guys.
Thank you.
Bye.
Take care, Kath.
Bye.